Inflation is continuing to ease. The annual pace came in at 2.1% in the June quarter, down from 2.4% in March, and even softer than the market's expectations of 2.2%. And that's despite an 8.1% jump in electricity prices as the government rebates came to an end. The main contributors to the quarterly rise were housing, up 1.2%, food and non-alcoholic beverages, up 1%, and health, which rose 1.5%. Offsetting that was a 0.7% fall in transport costs. But the real focus is on core inflation, which excludes the more volatile items. This is the true mean, which rose 0.6% in the quarter, right in line with the RBA governor's expectations and below what the market was forecasting. On an annual basis, core inflation was steady at 2.7%, highlighting that inflation is sustainably within the RBA's 2 to 3% target band. So what are the three big takeaways from the June quarter's CPI? 1. Core inflation is now firmly within the RBA's target. 2. Inflation in housing and market services has moderated. This reduces the upside risks. And 3. This clearly opens the door for the RBA to start cutting rates, starting with a rate cut in August, then again in November and February, and then again in March. Most of the components in the CPI came in as expected. The only real surprise was a softer than expected rise in holiday travel and accommodation. Secondly, housing costs, including rents and dwelling prices, were in line with our forecasts. And interestingly enough, electricity prices actually fell in the month of June, not because of the rebates, but rather because there was a drop in the underlying energy bills. And if we look at the momentum in core inflation, that is, the annualized pace of an increase in core prices over the last 6 months, we find that it's running at 2.6%. That is well within the RBA's target band, suggesting it will still be around this level, if not lower, in early 2026. And finally, we can turn to the monthly CPI indicator, for while it does have some issues, it's the most complete and up-to-date data source we have on prices. Its true mean measure of core inflation is currently running at 2.1%, pointing to a clear downward trend in core inflation. It is true that energy prices are expected to rise again as the cost of living rebates expire. That will likely push headline inflation above 3% by the end of the year. But core inflation, which strips out that volatility, is expected to fall in the lower half of the target band in 2026. And don't forget, auto fuel prices are down 10% over the year to June, thanks to lower crude oil prices and a stronger Australian dollar. We don't expect to see auto fuel being an inflationary force again until 2027. In short, the June quarter CPI confirms that inflation is moderating steadily. Yes, global risks remain: tariffs, energy shocks, and more. But the domestic data is clear. Inflationary pressures are easing, and the RBA now has the space to begin easing monetary policy. We'll see you next time.
The content of this recording is informational and of general nature only, and is not intended to constitute a research report or reflect any recommendation or financial advice. It has been prepared without taking into account your objectives, financial situation, or needs, and investment decisions should not be based on it. You should obtain your own independent advice before proceeding with any investment decision. Whilst every effort has been taken to ensure that the contents are correct and any opinions, forecasts, conclusions are reasonably held based on information at the date of recording, Westpac does not make any representation or warranty as to the accuracy or completeness of the statements or information contained in this recording, and any liability therefore is expressly disclaimed to the extent permitted by law. None of the material included in this recording should be copied, published, or reproduced in whole or in part without the prior written permission of Westpac.